I'm going to overlap a bit with Barry, but I'm going to do so much more from a business perspective in terms of what some of the macro trends that Barry spoke so eloquently about mean for American companies and more broadly foreign business on the ground in China. And finally, let me just add that it's really a great honor for me to be on a panel with both Yasheng and Barry, who are really two of the giants in the field. So with that, I'm going to really try to do sort of 5 things, much more emphasis on policy than the China card or politics. I will touch briefly on politics at the end, sort of disclaimer in terms of the U.S. Chamber of Commerce. We are involved in the political process, but not in the presidential race. We don't do, as my CEO is very fond of saying, the U.S. Chamber does presidential policy, but we do not do presidential politics. Of course, we are involved in House and Senate and local races. So I'll provide just a brief introduction to the Chamber and who we are, talk a little bit about the market opportunities that our members see, as well as the challenges, with some attention to the operational environment. I think Barry alluded to some of the trends in terms of the slowdown in the Chinese economy, the changing nature of the Chinese economy, and talk about what those trends mean for American companies in a sort of more tangible way. And then I do want to drill down a bit on policy and what, if you were an American company looking at the policy environment in China today, if you're looking at what is coming out of the system, out of both the party and the government, because increasingly it's just as important to be looking at what the party is saying as what the State Council is saying. Perhaps more important today to be looking at what the party is saying than what the State Council is saying. What that really means and what foreign companies are feeling as a result of what they're seeing. And then I want to talk a little bit about investment. Investment is a great opportunity in the U.S.-China relationship. We're actually seeing that opportunity realized. I think, Clay, you alluded to that first thing this morning in terms of what Chinese investment means here for the state of California, which is also my home state. This is my home city. But also, obviously, many other states. We at the Chamber really see Chinese investment as an opportunity. We want to encourage it. We have a number of platforms that we're using to encourage that investment. And then I'll provide a brief look going forward. So just briefly in terms of the Chamber, the U.S. Chamber is we call ourselves the world's largest business federation. We have over 3 million members in our federation. Our membership is cross-sectoral. It is also, we have the largest of the large multinationals. We have also small and medium-sized companies. We have also members, foreign members that are incorporated in the United States that are contributing jobs, growth to the U.S. economy. Their operations are members, some of them are members of the U.S. Chamber. The international division of the Chamber, and just to be clear, we also, not to be confused with the American chambers, there are over 100 American chambers around the world, which we charter. We have 3 outstanding ones, or actually, well, we have 5 American chambers. We have one in Beijing, we have one in Shanghai, one in Guangzhou, also one in Hong Kong and one in Taipei. So there are 5 there regionally, sort of in the greater China area. We are, I guess you could call us the mothership in Washington, across from the White House. We work very closely with those American chambers, but just want to, in case you're confused about the U.S. Chamber and the American Chamber. The international division is the largest division at the U.S. Chamber of Commerce. We're a team of over 80 policy experts and analysts. I think we now host over 12 or 13 bilateral business councils. I should add the U.S.-China Business Council, my former employer years back, is a separate organization, but U.S.-Japan Business Council, U.S.-Brazil Business Council, U.S.-India Business Council, Korea, Egypt, and so on and so forth are all housed within the U.S. Chamber of Commerce. And of course, we have a China Center at the U.S. Chamber of Commerce, which I'm responsible for. And the China Center is really about shaping a better policy environment for our members, also for the relationship, to support two-way opportunities, which we see of great value to both sides. Policies like a U.S.-China bilateral investment treaty, for example. So quickly, in terms of the opportunities, China certainly remains a top priority for our members. Perhaps down a bit from where it was a couple years ago, but it is still a top priority, a top 3 priority. You can look at the surveys from any of the AmChams, the U.S.-China Business Council, very much a top priority. We calculate at the U.S. Chamber of Commerce, it's a $500 billion market, and that includes U.S. exports to China, U.S. investment in China, and sales by U.S. affiliates in China. We believe the market, in fact, should be considerably more for American business, but it's still a very substantial market and continues to grow. And certainly the export story has been an outstanding one for states across the country. The U.S.-China Business Council has done a terrific report annually that documents U.S. state or export growth at the state level. Obviously, the drivers for corporate interest are well known in terms of China's growing consumer economy, urbanization. I think, and obviously we're seeing, as Barry alluded to, some of the changing emphasis of policymakers moving away from trying to move away, I should say, from an investment-led economy to an economy that's more reliant on services and consumption. And obviously, our members, particularly in advanced manufacturing, see China as increasingly as an innovation hub, not just made in China, but developed in China. And certainly the nexus between innovation and consumer demand and consumer economies is quite a strong one. On the flip side, of course, we have some of the business challenges. This is a slide actually from our American Chamber of Commerce in Beijing, American Chamber of Commerce in China. And you can see, I like this slide because it shows you how the challenges identified by companies on the ground have changed over time. It used to be that the focus was very much an HR. Look, I think there's always been a focus on inconsistent regulatory interpretation and unclear laws, but what we've seen for the first time in 2016 was that issue jumped up to the top. You continue to have labor costs as an issue, finding good talent, qualified employees, that's a perennial issue. Obviously, obtaining licenses, that's also a regulatory issue. So I think if you add, number one, the inconsistent regulatory interpretation and unclear laws and obtaining licenses, required licenses, which is another 29%, you can see that there are some real concerns about the regulatory environment in China for American companies. In terms of the macro trends and how those are impacting American companies on the ground in China, and to some of Barry's excellent points, you can see that revenue growth is slowing. It's not slowing across the board. And here, this slide also really illustrates sort of the dual economies that we're seeing in China today. You have one economy, which is sort of the old economy, perhaps concentrated in the Northeast, steel, commodities, industrial and resources. You can really see the drop there in revenue growth. But if you look at other areas like services, technology, the consumer-facing economy, you can see that revenue growth remains quite strong for American companies on the ground. Perhaps this slide's a bit more useful because it looks at profitability. It doesn't just look at revenue growth. And here's where you see, if you look at that orange bar in particular, you can see kind of a downward trend going back to 2011. Some of that's tied to rising wages. Margins for U.S. companies operating in China are down, and you are seeing this. It's not a steep trend, but certainly a downward trend in terms of moderating profitability. So let me go a bit deeper here on policy, and And some of this is very much going on now, I think, as Barry touched upon. Some of it's also forward-looking in terms of what American business is seeing on the ground as they're looking forward. And this is perhaps a bit repetitive from what Barry said, but if you look at the development plans on the one hand, and you look at policies like or normative documents, plans like the 13th five-year plan, obviously there are sub-plans. Every municipality has a 13th five-year plan. Every province has a 13th five-year plan. Many have industry-specific five-year plans. You look at policies like Made in China 2025, Strategic Emerging Industries, which is very much incorporated into the 13th five-year plan. It's something Barry mentioned. More recently, in the outline of National IT Development Strategy, you can see a heavy emphasis on creating national champions and creating economies of scale. I think it's fairly clear, and I think then on the other side, some of the recent laws and regulations which foreign companies have been seeing come out of the system. You have the national security law, the counterterror law, the NGO law, a pending cybersecurity law, which we expect will be issued by the end of this year, as well as pending guidelines for banking and insurance in terms of the kinds of information technology products they have to procure. Can they procure outside of China? Can they procure products that have IPR that's outside of China? Can they procure products that have source code that's not disclosed? Can they, and then the pending foreign investment law, you see a heavy emphasis on national security and really quite an expansive definition of national security to include economic security, agricultural security, cultural security, a very broad definition. And I think if you're a foreign company, in particular in a regulated industry, in one of these industries that China is prioritizing, I think you probably are wondering, what is your future? How much space is there to develop and to grow in China? And of course, that's on top of some of the existing market access restrictions that companies face in terms of their ability to invest in particular sectors of the Chinese economy that I'll talk about momentarily. This next slide, again, goes to the point of what we see as a increasing interface, again, with the goal of creating national and global champions, which is something we certainly understand. American business understands. American business welcomes a more innovative China, welcomes a Chinese business community that's competitive, that's investing abroad, including in the United States. But I think as we look at the policies that are coming out of China with regard to, on the national security side, or justified, I should say, on national security grounds, policies that restrict the flow of data, that require data to be stored within China, some of the technology reviews and standards that are being adopted that are different, certainly, are not inconsistent with globally accepted international standards, the so-called secure and controllable standard for ICT. And then you look also at the industrial policy side and some of the policies that we're seeing emerge tied to Made in China 2025, for example, as well as the vision for SOE reform. Obviously, we've seen many state-owned enterprises in key sectors that were already quite large, where in some instances you had oligopolies, for example, in rail, and you've seen those consolidated into a monopoly. So this is something that we have written about very recently. Actually, we just released earlier this month, actually just prior to the G20 meeting, a new report. It's actually not a China report. It's really a global report. And it looks at some of the concerns around deglobalizing or efforts to what we would call deglobalizing the ICT industry. And it looks at policies across the world, including in the United States. Certainly no country is, every country, I should say, has policies that require some degree of data localization or even production localization. But I think as we looked at what's going on around the world, and we considered the expanse of ICT regulation in China, as well as the importance that China plays in global ICT supply chains, we felt that looking at China and trying to assess the cost of some of these deglobalization policies to the Chinese economy itself was a worthwhile endeavor. And so we hired an economist to actually take a look at what the cost to the Chinese economy would be of these policies, and we concluded that the cost looking out to 2025 would hit $3 trillion annually to the Chinese economy. Now, of course, if you're in Beijing and you're assessing a report like this, obviously the question is, how can you put a price on national security? I think from our perspective, the point would be is that these, or in any country for that matter, but I think from our perspective, the point would be that the price of such policy, that there is a cost to such policies, that pursuing these kinds of policy approaches, I think to the point that Barry made about a larger role for government intervention in the economy it's not free. It's not without cost. I have another report up there, which was a report that we issued back in 2014 that looked at China's application of its relatively new anti-monopoly law, and how that law is being used in certain, has been used and continues to be used in certain instances to advance an industrial policy agenda. What I would say overall, and again, these are, I've picked some comments from the EU Chamber in terms of the mood in Beijing, and again, this is the EU Chamber of Commerce in their most recent report noted that the environment is, and again, in their words, increasingly hostile and perpetually tilted. Obviously, the slowdown in reform, I think, particularly when one considers the expectations tied to the World Bank DRC China 2030 report that was issued back in 2012, and the third plenum decision, that the symbolism of the third plenum has been trumped by substance, I think was the words that the EU Chamber used. Just investment, and again, this is an area of where we see an area of great opportunity. Chinese investment is advancing at a record pace. 2015 hit a new record. Actually, Chinese investment annually has been hitting a new record for a number of years, or breaking records for a number of years. This year, already, China, in the first half, China had invested $18 billion in the United States. Substantial investments in Europe as well, headlined by the Syngenta deal, of course the KUKA deal that was recently announced. And clearly, notwithstanding some of the concerns about capital flight, the government has placed a great emphasis on the going out strategy. And obviously, the U.S. economy is quite open to foreign investment. We want to see foreign investment, including from China, Europe as well. And you can see here in this chart, this is the source for this chart is the Rhodium Group, which is doing probably the best work on China's overseas foreign direct investment around. And you can see just how steep that increase has been. And obviously starting from a very low base, but certainly it's been a very steep rise. And by some metrics, Chinese investment, the stock of Chinese investment in the United States in just a few years is now approaching the stock of U.S. investment in China, which was built up over quite a number of years. Although I think it may be the case that the stock of U.S. investment, because of retained earnings and whatnot, is understated in China. But I will say that in contrast, we have seen a marked slowdown of U.S. investment into China, whereas U.S. companies were investing $5 to $6 billion a year in China throughout the period of reform. We're now seeing a significant slowdown. Some of that is tied to the financial crisis. Some of that is tied to the slowing Chinese economy. But some of it's also tied to market access restrictions. Some of it's tied to some of these regulatory policies that I've talked about. And China is, based, according to the OECD, it is the most restrictive investment market of all of the G20 economies. And this I think this in particular has been a useful chart for the U.S. I think for both sides, the negotiators, both sides on the ongoing bilateral investment treaty negotiations, because you can see the red line is where China has restrictions on foreign direct investment. The yellow line is where the U.S. has restrictions on foreign direct investment. And so you can see just how great the asymmetry is in terms of the openness of the U.S. economy, U.S. investment environment when measured up against the investment environment in China. Looking forward, so I will touch on politics briefly here, but I think everyone recognizes, if you're just tuning in, we do have an election on November 8th. I'm happy to talk about, if people have questions about TPP, I'm happy to take those in the Q&A, but certainly we will wake up on November 9th with a president, with a new president, one way or the other. And I think, I don't want to state that the entire table will be reset, but there will be certainly a new reality. And I think there remains hope that there will be a vote on TPP in the lame duck. And of course, China will be going through a political China already is in the midst of a political transition with the 19th Party Congress. And I think, as you've heard from a number of speakers already, there are concerns, I think, on both sides that we will see perhaps a tougher line coming from both sides. It's unclear how much flexibility China will have in a year of political transition to perhaps, hopefully, to complete a bilateral investment treaty in the coming year. Obviously, there are a number of irritants that are well known, well understood, irritants on both sides. China has its concerns. Market economy status is the top priority. Along with that, overcapacity, where you have significant concerns about that issue in the United States and in Europe and in other economies. This issue of global champions. I do think this is an issue that the next administration, as it looks at the kinds of economies of scale that are being created in China and the ambitions that are reflected in some of the policies, I think this is probably an issue where there will be more attention in the next administration, regardless of who is in the White House, the issue of FDI access and treatment, and of course IPR and cyber. Opportunities, again, not to sound like a broken record, but Chinese investment is a significant opportunity, and obviously the bit. I think the asymmetry in investment is something that we don't want to. We don't want our politicians to move from talking about the trade deficit to talking about an investment imbalance, or a trade imbalance to an investment imbalance. So liberalization in China it's time for that. China joined the WTO in 2001. That was something the U.S. Chamber of Commerce and the entire American business community came together to support. We're now 15 years beyond that. We're 3 years beyond the third plenum, beyond the World Bank DRC report, and of course the inauguration of the Shanghai Free Trade Zone back in 2013 as well. So now would be a great time for China to begin taking those steps that I think Barry highlighted and with which I very much concur, to begin opening wider. And I will leave it at there. I'll leave it there. Thank you.